Okay, it is time to start building some portfolios. So a portfolio is used so that you can have some idea as to what future performance could look like. So like for example, if I invest $500 a month for the next 10 years, and this is how I invest that money, what do I expect the result to be, right? And it gives you a bit of insight and encouragement to keep investing, right? And so we're going to start doing that, except that you've got a number of different portfolios that you can be building, not just for you. You've already built the one for you, but now we're going to be building them for other people. And so we've got the first. I think we've got four portfolio projects. So first things first, there is a portfolio projects module that has everything you need. You need to use this template. We'll go over it in a minute. And then here's the lecture, which is what I'm doing right now, right? And then you're going to get, like this week, you're going to get to portfolio project 3. It's going to have a bunch of different scenarios. Um, and so it's going to ask you, okay, use this template, watch this lecture. And we're going to do both of those things. And then it gives you a scenario, right? So we've got a hypothetical 25-year-old single mom with 2 kids. She makes $28,000 a year. She has $1,000 to invest right now, and she wants to invest another $50 a month going forward. Assume they'd like to buy a house in 10 years. So, I get students every semester going, it's impossible, right? Well, who says she's going to buy in the Bay Area, right? Or maybe she's got a parent that's going to help her. Do not get hung up on the goal of it's impossible. I mean, you can move to Cleveland and you pay 50 grand for a house. So, or you could go to like Visalia and you can get yourself a nice little 3-bedroom, 2-bath for a couple hundred grand. I just had a cousin buy a place in Tracy. He's 55 and older, so that it was a little bit less, but it's still 250, 260 grand. So you buy a condo. So don't get hung up on the goal, right? You've just got 10 years. So that's what we've got to do. So let's take a look at the portfolio template. First thing, you got to note that there's a bunch of different tabs at the bottom. Now, this is an Excel file. You can download this file to your desktop and then import it into Google Sheets and use Google Sheets. Or if you've got a Mac but you don't have Excel, it'll open up in Numbers. So you'll be fine. You can still use it. You don't have to have Excel. So don't pay Microsoft unless you already, unless you have to, which you don't for this class. So let's start by looking at each of the tabs. One, this little thing here. This is a quick and dirty way of calculating what a company's performance has been for the past 5 years, right? Super important that you don't immediately assume that that's what the company is going to be doing going forward. We'll talk about that in a minute. And then we've got years 1 through 5, 6 through 10, 11 through 15. So 5-year blocks going on for 25 years. And so you got to assume we're going to have portfolios are going to have to be built for 25 years. So in each of these cases, it's asking you for a recommendation, and it's asking you for beta, which I'll show you where you can find that. I'm less concerned about beta, but beta is the definition of beta really is how volatile is something. We'll talk about that when we start looking at individual stocks. Allocation, what percentage of the money do you want to go toward it? What do you think the return is going to be? And then does it pay a dividend? And I'm limiting you to individual stocks, bonds, mutual funds, and ETFs. Now, we just learned about ETFs, right? So you should be like fresh and be like, let's go on the ETFs. It's a wonderful vehicle. And you can tell from my portfolio, I think I've got more invested in ETFs than I do individual stocks. And so now the question is, got it. We've got our scenario. So what's the first step? First step is we need to plug in the investments. So we got $1,000 to invest and $50 a month. So we got to plug that in and $50 a month. Okay. So now we're started. We're ready to go. Now you just got to go pick your stocks, your bonds, your mutual funds, your ETFs, right? And you're kind of like, I don't know. What do I want to do? And so some of you are going to be like, I'm just going to go buy Nvidia and Tesla and Amazon and Google and that's totally inappropriate, right? When you're building these portfolios, what you do in the portfolio that we have a Market Watch, you go bananas. Go for it. 100%. I'm all in on NVIDIA. Good for you. But not when we're building these portfolios. When you're building these portfolios, I'm looking for diversification. And that doesn't mean, five different technology companies. If you like technology, got it, put some in here. But I'm also going to be looking for energy. I'm going to be looking for consumer products, right? So maybe if you want NVIDIA, give me some Chevron or give me some, maybe McDonald's, maybe give me some Chevron and Procter and Gamble. Give me a Target. Give me Costco or a Walmart. And if you want to buy individual stocks, and because I'm looking for diversification, but if you're looking for ideas, oh my God, I don't even know where to start. I hear that a lot. Let's take a look. Let's copy this. Let's go talk to ChatGPT. Now, I use ChatGPT every single day. And I always start by saying hi or hello because he's so incredibly nice. I need, and then boom, paste. I need a investment portfolio for a hypothetical 25-year-old, blah, 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 blah. Okay? That's going to give you generic. But now you want to add your own sauce, right? I'd like focus on healthcare, technology, and real estate, right? Maybe you're like, real estate has been, I don't know. And then I'm sorry, I don't know how to spell. Thankfully, I've never had anybody from the English department take the class, or else I am fairly certain they'd be sending me my homework assignments back red inked. So, I mean, let's say we want to do that, right? And this, and say, I'd like this separated into 2 5-year periods. What's it say? First of all, thankfully, it knows me and it just says, okay, Cologne doesn't know how to spell. We're okay with it. So it's going to start giving me investments. Okay. Now, look at that technology and allocation, low cost. It's giving you the rationale for these investments. And I love this. Expected rate of return, 6 to 8% a year, volatility high to moderate, blah, 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 blah. Okay. Phase two, you'll notice that the technology allocation declines. Why would they do that? Well, the reason why they do that is because we're getting closer to the end date. We want to take less risk. You'll see here we've got cash, T-bills, 10%. That's essentially cash. We'll talk about that in a minute, okay? And so this is what a ChatGPT would recommend. But let's go to our own diligence here, okay? Like, for example, you would never just put VGT. Like, what the heck is that? So I like to use Yahoo Finance to do a little bit of my due diligence. So I just go to Yahoo, I click on finance at the top here, and it's asking me, it's saying the stock symbol's VGT. So let's go take a look. VGT. Tell me what you got. Dun, 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 dun. It takes time because it's wanting to make sure it can load their ads, right? So information technology index fund, got it. That's interesting. So it's going to give me all kinds of information. Was the close at the 52-week range? It's going to give you this thing called beta. Okay, so you're going to find beta here. What's the 5-year monthly beta? 1.23. So beta, I'm going to give you the short story, and you'll never hear from me again. Because beta really isn't used this way anymore. It used to be used this way a lot. But beta is essentially a measure of volatility. And how much does something go up and down? One would be like the S&P 500, which would be the market as a whole. How volatile is the market as a whole? The beta would be 1. So a beta of 1.23 means it's going to be, maybe 23% more volatile than the S&P 500. That's one way to really think about it, okay? If it has a beta of 2.2, maybe it's going to be a couple 100% more volatile than the S&P 500. The S&P 500 sort of being the a stable market, and even it bounces all over the darn place. But it just sort of like in the back of your mind, it'll give you an idea. Okay, this thing might move around a bit, good or bad, right? So let's say, for example, let's say we like it, right? So ChatGPT says how much? ChatGPT says 25%. You're like, okay, I kind of like this. So now what we need to do is we put in, right? So we want is it VGT, and then just tell me, right? Vanguard Info Tech. Okay. And you give me the beta. What did we say it was? 1.23. Yeah. That way, in your head, you're going to be like, okay, this thing's going to be a little bit more volatile. ChatGPT recommended how much? 25%. Let's say you really like it. You're like, I want 35% of that. Got it. Now we need a projected return, right? And so now is where we need to do just a little bit more work. So let's go back to Yahoo. What we do on the chart is click the 5-year chart. Okay, so this tells you what was the performance like over the last 5 years. And that's up 127%. But let's go back and use our return calculator. It's currently at 736. So here what we want to do is we want to put 736. And then what was the price 5 years ago? 5 years ago. And just move this, move it over, right? The mouse. And it'll take you over, then it'll take you 325. So we put in 325. So this thing's up about 25% a year over the last 5 years. That's extraordinary, right? Which is why I've got bright in red. So past results are not indicative of future performance. You just gotta keep that in mind. We've had an extraordinary almost 3 years in the market. I mean, just unprecedented. And there's a lot of reasons for that. We could debate about that all day long, and but we're not going to, because then you'd be like, my God, he's still talking, and it's like 2 o'clock in the morning. We don't want that. And so this is where you need to use your own brain. How do you feel? Right? How do you feel about where the economy is going? Do you feel like, man, we're crushing it, we're going to keep crushing it, right? This whole concept of American exceptionalism. And are you into that? And if you are, then great. Maybe you think the markets are going to continue just to charge on. But are you like, what, inflation's still a little bit high, right? Gas prices are still a little bit high. Housing prices are still a little bit high. It's still not that easy. And I think there'd be a whole bunch of people that would agree with you on that. And so, this is where your gut comes in. You got to go, I think we're going to be okay, but I don't think it's going to be 25%. So let's go and say, I think it's going to be 15%. This is you using your judgment. This is really important. You could also, this is why we've been studying so much and, reading about what's going on in the market so that you've got your own gut check, okay? The next thing we need to fill in is dividend interest rate. Does this thing pay a dividend? Why, indeed it does. Yield 0.041. So 0.041, right? I hate it when it does that. So you got to go 0.0041. Yeah, there it is. So it's like about 0.5%. So now we got our first company in here. You fill in the rest. So here's one of the alternatives. Here's one of the things that when you think about is it is recommending, where is it? Real estate, US broad, dividend and value. It's recommending Bill, which is a short-term. Let's go take a look at it. It is a short-term, super, like, it doesn't pay very much, right? Yield 4.32%. Geez, maybe I should shut up. What's it look like year to date? What's the volatility been like? Okay, so that must be it. It goes up, it pays, it goes up, it pays. It's pretty consistent. But it's a short term, 1 to 3 month T bills. Gosh, maybe we do want to do that. I mean, it still looks pretty good. So maybe we put in Bill. And what's Bill's beta? Does Bill have a beta? 0, right? Because it's a bond fund. It's perfectly fine. Yield 4.32%. So when we get to something like this, allocation, let's see, 125%. Projected return, 0, 0. Because this is a debt instrument, right? It's a bond fund, essentially. You're going to put in that 4.32% here. That's extraordinary, okay? And let's say you are thinking, got it, I would like a bond in here. And so I say you could do stocks, bonds, mutual funds, or ETFs. So maybe you want to put a bond in here because bonds, US government bonds, I mean, that's like backed by the full faith and credit of the United States government. It is the most secure investment you can do. So let's take a look up here. How do we find bond yields? So a bunch of places you could do it. I like Bloomberg. I like Bloomberg for a lot of stuff. But if you go to Bloomberg, go to markets. Come on, go to markets. And we go to markets, fixed income. And then now it's giving you this little thing off to the side, a quick review on what yields would be. But maybe I can go over here and it gives me a broader view, right, on what are yields. And it really is a ton of information here. And so let's see, I want US because I don't necessarily want to buy, maybe you want to buy a Japanese bond, right? And this is getting, all of this doesn't matter. You want to get to the yield. Don't look at the coupon, look at the yield because the coupon's going to vary a little bit. So I could buy a 10-year government bond, which means it's got like almost no risk whatsoever and get 4%. So maybe I want to do that. Maybe I want to buy a 10-year, and this is going to be in the portfolio, both pieces of it, 10-year USB, US government bond. It's not going to have it. And I want 25%. And I'm not going to have a projected rate of return again, but I am for the next 10 years, I'm going to be getting 4.03%. So this, you're going to be like, wow, why wouldn't I just buy Bill? Here's why. The Fed, the Federal Reserve Bank, cut interest rates last month, and they're expected to start cutting interest rates more over the next period of time, right? They need to do that. Your job market is getting a little squirrely, so you can expect interest rates to come down. When that happens, that 4.32% is going to continue to decline. By the end of next year, it's probably going to be closer to maybe 2.5 or 3. Whereas we buy this government bond, we're going to be getting that 4.03% locked in for the next 10 years. We've got no risk, right? And then we've got 85%, so we've got 15% more to put whatever we want in it. So maybe you want to put NVIDIA, or maybe you want to do something, or maybe you want to diversify. We go back to, and maybe because you wanted healthcare, you put in, XLV. And once again, do your due diligence, look up XLV. And okay, got it. It's interesting. Who are some of the companies that are in there? Ooh, I like it. Eli Lilly, Johnson and Johnson, United Health Group, Abbott. Oh, I like this one. I don't know if you do or not. So let's just put in XLV. XLV, and what's its beta? Just for grins. Beta 0.68. Okay, that means this thing's going to be pretty stable, right? And we want to put in 15% because that means that's what we got left, right? Now we got our 100% number here. We need our projected rate of return. So let's click 5 years. It's currently 142. And let's see, where was it 5 years ago? 5 years ago, it was 108. So it's not a barn burner. 6.3%, right? But you're like, you know what? That was during COVID and there was madness, and I think it's going to do better. Got it. Okay. So it's going to do 6.3%. Does it pay a dividend? Why, yes, it does, 1.75, which is great. So when you consider total return, if it gets at 6.3 and the 1.7, you're going to be getting 8%. 8% on your money. Man, that's great, right? And that is a nice solid portfolio. So now let's just step back, take a little look, right? We have $1,000 invest now, $50 a month. This is how we're going to invest it, right? It's nice and diversified. We've got about 50% of it tied up in very low risk. And we've got, 35%, which would be considered higher risk. And then we've got, 15% in moderate growth. So the end of 5 years, we've got $5,737. Now we got to go build this other 5-year period. So you'll notice that $5,700 comes back. Now we got to put in the 50 a month, plug that in manually. And we need to bring over this bond, and because that bond is in there, that has to be right off the top, right? And what was the allocation on that? We did 25%, and we said it was 4.03. And then you fill in the rest. So now you've got 75% to fill out however you think is appropriate. And that's what this assignment is. It should take you a little bit of time. It should take a little bit of exploration. And before you put something into this person's portfolio, make sure you understand it. Go to Yahoo Finance, scroll down and be like, okay, this looks interesting. Okay, let me look at the performance. All right, it hasn't been gangbusters, but it's maybe down a little bit now or relative to where it's been. And we know everybody's getting older, and we know a lot of these drugs are that are coming on the market are going to be helpful. And so, maybe you like this, or maybe you don't, right? Maybe you like the whole idea of the real estate instead. But use ChatGPT as a tool to help you think. Use ChatGPT as a way to sort of unlock ideas that you hadn't thought about before. And do not just throw in a bunch of Tesla and a bunch of Nvidia, because you're not going to be happy with your mark if you do. I'm really looking for diversification, and I'm really looking for you to be thinking long term, and that's how you build wealth over time. Okay, so I hope this was helpful. It probably took a little bit longer than I would have liked it to take, but I wanted to begin walking you through how you could use ChatGPT to do some of these things, and to begin to help you think more broadly about investing. But at the end of the day, it's your gut, right? It is you every week, every day, paying attention to what's going on in the markets and in the economy, and then you having an opinion as about how that's how you feel about that, and ultimately, do you think that the markets are going to keep going up or keep going down? And that will then determine how you build your portfolios. So as always, if you got questions, you know how to find me. This probably lasted longer than I would have liked, but it always does. Peace.